Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello, I'm Matthew Allen, Global Head of Financial Services at Evershed Sutherland. Welcome to the first in a series of podcasts exploring trends and opportunities in global financial markets in 2025. Each month, we will be hearing from our clients on a particular hot topic issue, which our own subject matter experts on both sides of the Atlantic will then reflect on in a separate podcast. Today, we'll be kicking that series off by looking at the seemingly inexorable rise in private credit. To help us do this, I'm delighted to be joined by Ed Jolly and Jack Gilbert at PGIM Private Capital, one of the world's leading alternative capital providers. Ed, Jack, it's great to have you with us. Maybe you could just introduce yourselves for the benefit of our audience. Ed, maybe come to you first.
Yeah, hi Matthew, great to be on. Ed Jolly, I'm a managing director within PGIM Private Capital. I co-head all of our corporate lending activity within the UK and Irish markets, and I'm based here in London.
Yeah.
Hi everybody. Yes, so I'm Jack Gilbert. I'm a principal in our London office. I've been with the firm 14 years, most recently helping build out our direct lending strategy in London, which represents our sponsor coverage efforts and our lending to private equity-backed businesses.
Great, thank you both. So looking at private markets, growing very rapidly, important segment across the private market universe. What do you see as the outlook for and trends in private credit over the next 12 months or so? And where's that growth come from over the past decade? And is that going to be sustained going forwards? And if so, where's that coming from? Ed, do you want to try and tackle that?
Yeah, no, sure. Happy to kick off. And I'll probably start with the second bit of that question, sort of kind of leads into the forward outlook. But if you step back and think about private credit as a sector, it's really evolved very significantly since financial crisis. Pre-financial crisis, mid-market companies in UK and Europe were predominantly bank funded, and then the financial crisis had various impacts. One of which was a bit of wake-up call to a lot of companies that were solely bank funded. So the virtues of having more diversification in capital structures, and then that combined with an ever-changing bank regulatory backdrop, which has driven banks to be more prudent and restrict their ability to lend, particularly in in kind of leverage finance markets where there's higher risks clearly. And so as a backdrop, we see that as that very much a structural shift and change, which will continue as opposed to a cyclical or temporary feature. And that's you've seen that in a lot of growth in various areas of private credit, everything from larger companies getting access to the traditional private placement market, which has grown significantly, all the way through to smaller private companies getting access to leverage finance away from the bank market, through direct lending and mezzanine. And interestingly, also seeing significant growth in non-corporate lending space. So thinking such areas as infrastructure, asset-backed finance, fund finance, to name a few. And we see those as all growing going forward. Another kind of topic for us is geographic, simply. So if you looked at our business, we were very US weighted 20 years ago. That's significantly grown as we've penetrated and put boots on the ground across other geographies. And then maybe just switching to 25 specifically, I can touch a little bit on the corporate lending outlook and non-sponsored, and then Jack can give his take on the private equity backed market outlook. On larger company side, it's been a fairly cautious outlook the last few years, from a investment spending perspective, which drives a lot of the flow into private credit markets. So lower appetite for M&A, and I'd say a lot of companies more operational focused. We do see that tone changing, and a little bit more positivity towards M&A, helped by at least normalization or stabilization of interest rates. I think companies getting their heads around that dynamic. So we'd be hopeful for a little bit more activity there. And then the other leg to non-sponsored that certainly we spend a lot of time in is with privately owned businesses. So those can be family held businesses, or entrepreneur led businesses, looking to do some kind of transformational activity, be it a shareholder buyout or an acquisition. We think some of those deals have been on pause for a little bit for the obvious reasons. We think there should be a little bit more impetus going into 25 to look at some of those transactions.
Jack, how do you see it on the sponsored side?
Yeah, I think it's interesting. I mean, a lot of the trends that Ed talks about, I think, are consistent across private credit as a whole, both the non-sponsored and the sponsored side. I mean, on the sponsored side, whereas there has been, sensitivity to rates, as Ed mentioned, and just generally lower M&A over the last couple of years, I think what's interesting is actually those sort of mega trends driving the expansion of private credit have really continued unabated, and we've seen sort of good deployment rates despite lower M&A, which is perhaps surprising in the LBO space. I mean, a couple of reasons for that. I think new sectors is part of that. We recently closed a deal with a football agency, so in the sports sector, which is new for us. We've seen things like public to private as quite a common transaction type, which has been enabled by trends in public markets. Things like refinancings and recapitalizations have been common. And also just, I think, new and innovative structures, whether that's working alongside banks in pari structures or just finding ways to work with different market participants. And so, yeah, as Ed mentioned, private credit, I think, originally came from taking share from banks and due to the regulatory nuances that underpin the banking market. But now we're seeing it grow into spaces, really into the public markets and places that used to be loans that went into CLOs, for example, now going into private credit. I mean, just to frame the opportunity set, we think there are 250,000 companies in the 10 to 100 million EBITDA range that are middle market fund services in the EU and US. And when you just think about the proportion of those currently in the private credit market, it would be very small. So it gives a taste of the runway we think is still to go.
It's a crowded market. It's very competitive out there. Tell me a little bit about PGIM's approach to private credit. And Ed, maybe I'll come back to you on the corporate side.
Yeah, no, absolutely. I mean, I think the first thing I'd say about PGIM is we've been doing it a long time. So, people talk about the private credit market as a relatively new institutional asset class. Given our heritage and insurance-backed business fundamentally as a starting point, we've been lending directly to companies in the US market for 80 plus years. And then if you looked at our UK, Europe mandates, we've been here active 30, 40 years plus. So we've got a lot of incumbent knowledge through cycles, and in our portfolio, we lend to probably over 1,000 companies globally. And key to that approach of how we look at it is the benefit of scale, diversification, but having boots on the ground. So we have offices across the geographies we cover across the US and then across UK, Europe, and now beyond. So we have a Sydney office and also a Mexico City office. And the key thesis there is having local people close to the companies. We want to get to know, originate, and underwrite. So, and that's both an advantage from a deal sourcing perspective, which is really key in this asset class. You need a differentiated way to find deal flow, very different to the public market where you can just trade on exchange. So having access to that deal flow is key. And then from an underwriting and credit performance, having the local knowledge and ability to manage the portfolio locally is very key. So that fits with kind of approach. But what that results in, if you look at our business at PGIM and private credit, is very broad. So we're doing everything from the investment grade private market, where we might be lending to a FTSE 100 or FTSE 250 company long term, all the way through to mid-market, privately managed, privately owned businesses, which have potentially a wider range of capital needs. So senior debt through mezzanine and minority equity potentially, continues to see that as a core focus. In addition to diversifying into other areas of the market, such as infrastructure, power, energy funding as well.
Thanks. And Jack, what's the approach then in your world?
Yeah, again, I think very consistent, and that sort of heritage that Ed talks about has really guided our strategy on the sponsored side as well. I think what's interesting about that portfolio of 1,000 companies he mentioned is about half our deals in any given year come from the portfolio. So it's a really important source of deals for us, but it also guides our thinking to underwriting and approaching new deals, whether that's which sectors to prefer or which companies within a sector to look at. And it also is very useful on the diligence side. I mean, we really take what I would call a sort of private equity approach to diligence. We're underwriting different risks to the sponsor. So we really do a top-down, third-party led diligence approach, both leveraging our in-house experience, but also working with third parties as necessary. And we find that by doing that work on the way in, it allows for better portfolio management, makes us a better partner, improves consistency of thought. And we very much have an approach of keeping a deal team in the front seat for the whole life of the deal for that reason.
So looking ahead, busy next 12 months, what would your top tips be for investors who might be looking to broaden their exposure to private credit? And what's your advice in terms of what you need to be successful in private credit markets today? Jack, come to you with that.
Yeah, so I think we've touched on the growth of the asset class, and I think that does give LPs today who are seeking exposure a lot of choice when it comes to manager selection, and those choices aren't always easy because manager performance has not been hugely divergent over the last sort of 10 years of expansion and through COVID. But we do think that will change materially in a more stressed credit cycle that will come at some point. And so, I think we really emphasize the importance of managers being cycle tested, of having an established workout team, and in Europe that really means experience in local jurisdictions of managing workouts. A really broad relationship set. I think on the sponsor side, obviously knowing private equity is important, but to successfully manage a deal, you really need to know the founders of the business if they're still in place, the management team, other lenders. And so sort of broad relationship touch points and again, the sort of power of the network, really important. When it comes to strategies, again, I would really emphasize breadth. I think if you've got a narrow strategy, you can be a deal taker when a deal that fits that criteria comes along. So we do think breadth of strategy leads ultimately to better credit selection. We find good managers really think about risk, return per unit of risk, rather than purely focused on pricing to a set hurdle. And we also find that good managers don't follow the crowd. I think sometimes some of the sectors with the highest levels of activity, and healthcare would have been an example of this over the last few years, actually have some of the weaker fundamentals. And so having the diligence process to assess those is really important. I think there is an optimum size currently in private credit as well. If you're too small, you can't access some of the deal flow we've discussed. But if you're too large, you can lose the mentality that every deal matters and become a little bit of an index fund, without the discipline to say no to deals. And yeah, if you can do all of those things, we think there are very attractive returns to be generated in private credit, but also simultaneously that the market can really provide compelling partnership and flexibility to borrowers and sponsors.
Ed, any final thoughts from you on that question about outlook and tips for investors?
I think Jack covered it well. I think you just got to have a very clear, when you're kind of looking at investors, clear differentiation. I think the channel piece is critical. I mean, we see, even just geographic diversification. If you look at our business in any one year, you'll see quite a lot of variability in origination volumes by country, and it sort of typically evens out over a year. So we get to similar kind of a level of activity, typically growing each year, but there's a lot of deltas within those countries. I think it speaks to the ability to pick the right deals within those, but not not being under pressure to chase things in any particular market at any point of time, which is pretty key, and openness to other things such as non-sponsored funding. Clearly, I come with bias given I focus on that, but again, a lot of other investors, that capability is not so prevalent.
Ed, Jack, thank you so much for joining us today. I'm going to have to wrap it there. Really helpful insights, really interesting. And I know that our listeners will have much enjoyed that. And thank you to them, of course, for joining us as always. If you'd like to know more about how PGIM Private Capital can help your business, I'm sure Ed and Jack would be delighted to hear from you. So please don't hesitate to get in touch with them. If you need their contact details, we can help with that, or it's on the website, I believe. Please also look out for the next podcast in this series with Evershed Sutherland Partners, reflecting on what Ed and Jack have shared with us. That will appear on all our usual social media channels in the very near future. Thank you.
Thank you for listening to the Evershed Sutherland Legal Insights podcast.